are you paying too much tax? Yeah, I'm probably sure you're thinking you are, and that's fair enough, because you actually might be. And that would be the disappointing thing, because we don't want you paying $1 more than you have to. So a lot of this comes down to the structure of the business. And no matter what industry, no matter what product or service you provide, nor whether you're in a partnership or you're on your own or some other conglomerate, the same principle applies. You need the right structure, because the right structure can save you money by reducing the tax you've got to pay. It gives you flexibility when you're distributing income or adding or removing partners in the business. It enables you to grow without adverse effects, and it will give you the peace of mind knowing that you're set up correctly, not only for today, but well into the future. So if you don't get the structure right from the beginning, it can actually cost you, and cost you quite a bit. So the two main popular business structures for profitable trading businesses are either a company or a trust. Now, the other alternatives for micro businesses might be a sole trader or a partnership, and they're equally as important. But understanding those different types of structures and what's best going to suit you for your particular circumstances is the key. So obviously there are benefits for each. With a sole trader and or a partnership, you need to be careful because asset protection is a risk. So where you've got personal assets, should something go wrong in the business, you need to be mindful of that. Obviously you get an added layer of protection in a company or a trust, but of course you can't be protected against doing the wrong thing, but certainly in other instances you can. So companies and trusts are separate entities in their own right, and you are either a director and shareholder and employee potentially of a company, or you are a trustee or a beneficiary of a trust. Now, without getting too technical, all that means is there's different ways of distributing that income, and your particular situation, not just for you personally, but for your family group, can play an important role in that. In companies, there can be quite a deal of flexibility in the way you receive your income, or your family group receives the income. Similarly with trusts, but one of the main differences is that all the income generated each year out of a trust needs to be distributed, and if there's quite a bit and it's going to higher income earners, then you're going to be potentially paying a little bit more tax than you need to, but managing that's important. And obviously in a company, you only need to pay tax on the money you draw out. So any funds retained in the company will, or profits retained in the company, will be levied at the company tax rate of 25%, which is a bit more concessional than the higher income tax rates. So understanding all of that is important. And the way you need to consider it is what factors are going to be important to you. So asset protection, I touched on before, is one. Clearly tax minimisation is a big one, but control might be another one. Or whether or not you're generating active or passive income, i.e. whether it's coming from a business or coming from investments. The cost of your structure obviously is something you need to consider. The ease of administration would be something you might want to consider. The adaptability and flexibility, and potentially succession planning. So all those things you need to consider in terms of what's important to you, not just for today, but for tomorrow and beyond. Hope this has given you a bit of an insight into the importance of the structure of your business and getting it right, because if you want to save tax and pay not $1 more than you need to, then obviously structure is key. Thanks for listening. Hope you found this useful. Look forward to speaking with you soon. Bye for now.